So this is my actual stock portfolio, and let's walk through the top 7 stocks to buy now, each focusing on one of the most important technologies driving value in the market right now. Because when it comes to picking great stocks, it's important to focus on a company's products and not just their numbers. If you had put $10,000 into Nvidia 5 years ago, that would be worth $160,000 today. And that kind of massive growth happens when a company has the perfect product in a quickly growing market before that market appears, like Nvidia. So let's get into it and put my money where my mouth is by showing you my personal stock portfolio. So my portfolio is up for the year, up around $60,000 total for the year, although it has had some big swings. Just today, it's already down $8,000, and if we zoom out even more, it's up $120,000 over the last 2 years or so. And this is because, as you'll see, a lot of my investments are in high growth tech stocks, which tend to be very volatile. You have these big drops, but you also see just as quick rises. This is because I invest in my circle of competence, a concept from Warren Buffett that says invest in what you know. And what I know best is technology. I've worked as a solution architect for over a dozen Fortune 500 companies, and tech is what I know best. So our first stock sits right in that circle. It is a cloud company who has always had very impressive technology, but they have seen a 140% increase in their stock price over the past year, and they have the financials to back it up. So Cloudflare's goal is to make the internet itself work better, bringing the internet from the 1980s technology it's built on and into the 21st century. But today, the internet faces a problem that it's never seen before, with tools like ChatGPT or Google Gemini kind of changing the way we use the internet. See, for the first time since the 1980s, the total human website traffic is starting to drop, while AI traffic is rising exponentially. So this right here is a logarithmic chart, meaning a straight line here would be like a hockey stick on a normal chart. AI scraping is up 87% since January of 2025, and it's on track to more than double this year. And this can be a problem for people running websites because they basically have to pay for all this extra traffic to their website, but they're not getting any extra revenue from their ads. We've actually seen some academic websites that have even crashed under the load from AI bots. And the whole problem, they're not getting paid for that traffic. So Cloudflare's CEO has been very outspoken about this problem, saying that the business model of the web can't survive unless there's some change. And Cloudflare thinks that they can fix this problem because AI bots don't see ads and they don't pay subscriptions, so websites now have to serve more ghost customers without receiving any revenue for it. So my big bet on Cloudflare is that they will have the right tool to address this moment, and it wouldn't be the first time that they've done this. See, Cloudflare started out just hosting other people's websites. Then they realized, well, we should probably protect these websites too, so they added firewalls around it. Then they thought, if we're already analyzing all the traffic for bad actors, why not optimize the experience for good actors? And they've continued to launch tool after tool after tool to make their services better for their users. And their users ultimately are the internet websites that we use every day. And they have innovated so much over the years that today they basically run their own cloud service, which competes with the likes of Amazon, Microsoft, and Google, with some very big customers that anyone watching has probably heard of. And this is also why Cloudflare thinks that they're the company that will figure out how to solve the AI crawlers problem. But before we get to how they're going to do that, let's look at some numbers behind this stock, because it's way easier to have a cool story than to actually back it up with solid financials. So Cloudflare is a classic growth stock. If we look at their revenue over time, listed here as sales, we can see that it has been growing exponentially over time. Now, to do that, they've had to spend and invest a lot, which is why their net income has been fairly negative, although that has been creeping closer to zero recently. But because of that growth, this is a very expensive stock. They actually list this on Forecaster as 98% above fair value because they're comparing it to a regular software company. But at the same time, they do have a low risk of bankruptcy, and the stock is considered to be strong financially with a Piotrowski F score, basically a way to evaluate the strength of a company's financials, putting them into the strong zone for this company, which, as we can see, has just improved year over year. So Cloudflare's whole idea to solve the AI crawlers problem is to give website publishers control over how their website works. So if you want to sell your work to AI platforms, you can, but they have to pay for it. Which, if it takes off, this would be a multi-billion, if not trillion-dollar industry. It's a very hard problem to solve, but because Cloudflare has innovated so many times in the past, it does give me some confidence in their ability to do it again. But we can't talk about a high-growth stock like this without also talking about the risks. And the big risk here is this play may not work out for Cloudflare. See, Cloudflare makes the majority of their revenue through usage-based fees. Basically, the more people use Cloudflare, the more they pay, which is great when you have a good product that people want to use more and more every year. But if all websites are replaced by AI chatbots someday, that would severely impact Cloudflare. So this is a future where there's a lot of uncertainty. No one really knows what direction the internet will go next. But Cloudflare's CEO is, I think, one of the best CEOs in the stock market right now. He is extremely plugged in with what is happening on the internet right now, and he actually runs a public blog where he explains his thoughts probably a lot better than I even can. And so whether this current bet pays off or they have to innovate and pivot to something else, I'm willing to bet primarily on the CEO to lead the company into the future that the internet is moving into. And it does help that this is one of the few growth stocks that isn't super overhyped right now. It's on the higher end of neutral right now. It's not overbought and it's not oversold. And so I think this is actually a pretty reasonable time to get in on this stock if you believe in Matthew Prince's leadership, especially as Cloudflare keeps on growing their market share plus the overall size of the market as they move into other areas like cybersecurity. And so that's why I've bet fairly big on this stock. I have 172 shares currently, which is worth $31,500, and that is up 164% since I first bought in. And even though I've already ridden the stock price up, I think it still has substantial room to grow from here, which I sure hope so, because it would be nice to retire from corporate life someday, and I do think the stock market is the best path to financial independence for me, and probably you if you're watching as well. But okay, let's pivot now to two stocks that are some of the only AI companies that still look like a decent value in the market today. So let's start with the ultimate picks and shovels play in the AI space. I'm sure you've heard the analogy before. During the 1840s California gold rush, it wasn't the miners of the gold who made all the money, it was the people selling them the picks and shovels to mine all the gold. And it's going to be the same in the AI space. So instead of trying to pick the AI chip winner, Nvidia's already run up in price, and AMD is still fighting to get in on the AI data center business, there's one company that's happy to quietly sit back and make a fortune building the tools to actually manufacture these chips. TSMC. So TSMC is like the AI factory that enables all the other AI companies to run. Without them, you don't have NVIDIA, you don't have AMD, and without those companies, you don't have all the AI software that's built on top of it, Palantir, Google, etc. What makes TSMC special is they don't design the AI chips, they physically manufacture them. In fact, legendary investor Stanley Druckenmiller recently revealed that he had bought into TSMC trying to own the backbone of the AI industry. So I made a whole video on the strategy that Druckenmiller follows, but he's basically a billionaire protege of George Soros who likes to identify a trend in an industry, AI for example, and then invest in different segments of the industry as time goes on. So he started out with the AI chip makers like NVIDIA, then he moved on to some of the AI application companies like Palantir, but now he's moving on to the backbone of the AI industry, purchasing a very substantial stake in TSMC. And the numbers behind this stock look pretty good. The company's stock price is only up 30% for the year, which is way less than a lot of other AI stocks. And if we look at their fundamentals, their revenue has been growing very, very quickly over the last couple years. And according to their Altman Z-score, they have a very low risk of bankruptcy. An Altman Z-score is a financial metric used to assess the financial health of a company. Anything over 3 is considered very safe, very low risk of bankruptcy. They have a score of 9. And in fact, Forecaster currently rates this stock as 4.75% below the fair market value of the company. And this valuation is based on 3 different metrics. The first is their discounted cash flow. Basically, how much actual cash is the business throwing off? Cash is different from profits because profits are kind of on paper, you can kind of manipulate them, but cash is very tangible. And what's important is in a recession or economic hard times, cash is king. Second is the Peter Lynch metric, which is basically basically the price to earnings ratio, or PE ratio, which is a way to measure the value of a company. And then third is the economics value added. This is the amount of profit a company can generate based on its cost of capital. So if I buy some big piece of equipment, how much profit can that equipment make? But the other big thing with this stock, and kind of the elephant in the room when it comes to TSMC, is the global political situation that all spins around this one company. This has actually been a very active stock among politicians. You can actually see a bunch of them were selling it early in 2025 and into the end of 2024. And the company has been referred to as the most important company in the world, because now more than ever, AI power is a matter of geopolitics, and TSMC holds the key to that power. So as we see escalating tensions between the US and China, this stock is going to be involved in all of those, which could be enough to scare investors away, or it could be a chance to buy the stock at a discount. The company makes a decent amount of their revenue from the smartphone market, which helps kind of level out some of the bumps in the AI market, and they are a key supplier to some of the biggest companies in the world. But there are also some promising signs in the very long term for this stock. They've recently announced a $100 billion plan to build 5 new US-based factories, along with a lot of support from the current administration and even some subsidies to help them build these manufacturing plants. So I don't own this stock yet, but I am considering taking a nibble, especially as they expand outside of one geographic location and into other areas in the world, lowering their geopolitical risk while still offering some pretty attractive financials. So this could be a good option for anyone who wants to invest in AI while getting the geopolitical risk discount. It's like a shopping sale at Target, only on the world stage. But now let's go to the far other side of the AI market, the AI model makers. So there's really only one stock that is a leader in AI, has a big enough base to monetize their data, and is still cheap enough to have some serious room to grow from here. So Google for years was the leader in AI right until ChatGPT came along and took over the title, while threatening Google's biggest business, Google Search, which still makes up the majority of Google's overall revenue. So you may be seeing a pattern with a lot of these stocks. I do like to invest in companies that have some reason to be undervalued in the short term, usually due to some kind of fear that the market has around the company that I think is being overblown. And in Google's case, I think the risk of AI to Google Search is one of those areas. So for this stock, let's look at the risks that it faces from AI, especially in its search business, and then look at how I think Google will not only survive the current AI push, but actually become a much bigger company because of it. So Google has been working to embed AI into their Google search results. You've probably seen the Gemini summaries that show up in the results. But to me, these look more like a testing ground for their AI than a feasible product that would compete with the likes of ChatGPT. I mean, when you really look at it, it's not all that different from the Google summaries we've had for years for stocks, celebrities, places, news, etc. But the real play here is less on Google's current AI products and more on how they can use AI to supercharge their business, especially in the cloud. So if you're a user of any of Google's products, you may not be aware of how big their B2B business is. B2B meaning any business that sells mainly to other companies rather than directly to consumers like you and me. So I've spent most of my working career behind the scenes working on these mega deals between different companies. And the B2B market is actually much bigger than the business to consumer market. There's no definitive estimates, but a lot of estimates show that it could be as much as double the size of the other market, meaning businesses just making products and software for other companies is worth twice as much as actually selling something to end users. And this is why Google's bet on their cloud business is such a big deal for their future. So pretty much every company runs on the cloud these days. AWS, Microsoft Azure, and Google Cloud are sort of the big three. But even though Google is the smallest, they have probably the best suite of AI tools. So the strategy basically works like this. Google will use their AI products to attract new businesses to try out their AI tools and maybe use them for kind of niche use cases. But once they get them on board, they can then upsell them to other areas like computing or cloud storage. In fact, Google plans to spend $75 billion on AI data centers over the course of 2025, where they are racing to build their TPU infrastructure to enable their AI workloads. And TPUs are their tensor processing units that Google actually designed. And we can see just how important this investment into Google Cloud is going to be for the company. They actually break out their earnings onto two separate slides. The first one is for all of Google's services. This includes things like Google Search, YouTube ads, the Google network, plus all of their devices like their Pixels, their subscriptions, everything. And the second slide is just for Google Cloud. Now, the numbers here are a lot smaller. Google Cloud's only 12 billion, while the rest is 77 billion, but it's also growing a lot faster, up 28% year over year. Google Cloud is the growth engine for Google. But it's not their only bet. Google also has been investing heavily into Google DeepMind. In fact, they just released Gemini 2.4, and I believe this is actually just available for free. They also have their robotics division that they're investing in, and just fundamental research and development as they try to compete with makers like OpenAI. At the same time, you also have services like Google's Waymo, which is now arguably the leader in autonomous driving. I think one thing that always comes to mind when I think of Google is the fact that they are the company that kind of kickstarted the whole AI revolution we're seeing right now. This research paper, it's really famous, called Attention All You Need, is where they laid out the transformer models for AI, which is the type of AI that is used in everything from ChatGPT to Grok on X to Google Gemini. And so it's not just which company will build the best transformer model with more data and more computing power, it's also where will the next AI model come from, the whole new architecture. And my bet is still on Google. So Google is actually reporting new numbers relatively soon. In July 22nd is when it's estimated. But if we look at their numbers today, we can see just how quickly this company's sales have grown over time. In 2017, it was 110 billion, and that has grown to 350 billion in the most recent year, with profits of over $100 billion. And the company is actually currently listed at 10% below the fair market value. And then one chart that I always have to bring out at some point that I think is really cool is their seasonality. So this chart basically shows how the stock price tends to move up and down over the course of the year. And as we can see, it tends to continue rising through the back half of the year, although it may have a dip in October if it follows the average. And to show you one number that's a little more in the weeds, if we look at their raw data, we can actually see how much they've been spending on research and development every year. And that has grown from $16 billion per year to over $50 billion in their most recent year. Meaning Google isn't just focused on the near-term current things that are happening in AI, they are focused on inventing the future and investing heavily into that area, which as a technology company is what you need to win in the long term. Now the stock price is up a fair amount in the last 5 years, up 141%, and I've had some comments ask me why I only talk about stocks that have already run up in price. And there's two answers. One, good companies just do tend to be worth more over time, but you could have said the same thing back in 2018. Google had a 100% run up over the previous 3 years, and yet since then the company's stock price has risen an additional 189%. And then secondly, I own Google in my portfolio. I have 123 shares of it. And so even though it's up around 6% from where I first bought it, according to opportunity cost, holding a stock is the same thing as saying that I would buy the stock at today's price, ignoring some weirdness for taxes. But while AI is getting the limelight, let's now look at a company that you may take for granted or even have written off due to increased competition from autonomous driving, but this stock is up 40% from when I last talked about them, and I think this is just the start for this company. So Uber is absolutely an example of a company where I'm looking for value in a beaten down stock. And one of the big risks with Uber is a lot of people think they're going to be completely replaced when autonomous driving from the likes of Tesla takes over. So for this stock, let's start by looking at the risks and then look at the opportunities here. So Uber got back on my radar after billionaire investor Bill Ackman made a $2.2 billion bet on this stock. Bill Ackman is famous for beating the market year after year, but more recently, he has been focused on one type of company, a company that has really strong cash flow and a really strong brand. And this strategy has worked well. He's made a bunch of money off investing in Chipotle, but his more recent focus has been on Uber. And so there's two opportunities that he sees for Uber and then one big risk that we'll talk about. So the first opportunity is just a strategic one. As interest rates rise, car ownership becomes less attractive, potentially boosting boosting demand for Ubers. Basically, you're less likely to go and buy a car that costs a ton per month if it's actually cheaper to just ride around in Ubers. Plus, Uber has the ability to move into freight or shipping with their already pretty large network of $20 billion in freight under management. But the other big thing is the stock just looks relatively affordable right now. If we look at them on Forecaster, they're currently in neutral market mood, they're not super overhyped, and if we look at the fundamentals, the company's revenue has been absolutely exploding recently, and with this rise in revenue, the company has even managed to achieve a profit of just under $10 billion. And they've done it all while maintaining a low risk of bankruptcy and relatively stable financials. And this platform, by the way, I've showed it in a couple of videos now. It's called Forecaster, and it has some unique tools like the seasonality tool I showed you before, and it's just a really nice way to get a high-level overview of what exactly is happening with a company. They even have some pretty interesting AI features if you want to get a high-level understanding of the company strategically or through their numbers. So if you want to check it out, I'll leave an affiliate link in the description and leave a pinned comment. You get 10% off if you use that link, and doing so really helps support the channel, so I appreciate it. But the other big thing with Uber is the risks that it's currently facing, and one of the big ones is the risk from autonomous driving, because if everyone can just have their car go out and basically Uber for them, what is Uber's business model needed for anymore? But Bill Ackman argues that this risk is overblown, saying the long-term risk to Uber from autonomous vehicles is limited because, one, he doesn't think autonomous vehicles will replace human drivers anytime soon, and two, he thinks AVs, autonomous vehicles, would actually expand the market for rideshares, not drop it. So a company like Tesla might become a new competitor for Uber, but because they make it so much cheaper to operate a rideshare, that just expands the overall market, especially given Uber already has network effects from their existing user base. And Uber is already partnering with many of the leading self-driving car companies, including of course Google's Waymo and smaller companies like WeRide and May Mobility, and the CEO has even publicly said to Tesla that they would be open to partnering over competing. So I actually just bought some shares in Uber after seeing Bill Ackman's trades in this video, and now I have 100 shares valued at $9,000, and I just bought it like a week ago, so it hasn't really moved in price much. But now let's move to two stocks that I call passive income plays. And most investors who are focused on chasing the next Nvidia may miss out on one of the most consistent ways to build wealth in the market and actually beat around 90% of active traders. And we'll follow that up with my top way to invest in small, under-the-radar stocks without taking on too much risk. So first off, as we're chasing gains in these stocks, we need to pay attention to the two rules of investing. Rule number one, don't lose money. And rule number two, don't forget rule number one. So by far the easiest way for investors to buy stocks without taking on too much risk is to invest in ETFs, a basket of stocks that tracks some kind of index. You can buy an ETF that tracks technology or one that tracks luxury goods. But one of my biggest holdings today is VOO, an ETF that tracks the 500 biggest stocks in the US. It's not as flashy as some of the stocks coming up, and it's not super exciting, but this is my home base that I plan to use to build the majority of my wealth going forward. And it's this stability that lets me chase some of the more volatile but potentially higher reward stocks. So a couple options for this stock if you want to do it yourself. VOO is the ETF that I use from Vanguard, but if you use Fidelity, there's FXIAX, Charles Schwab has SWPPX, and your investing app of choice probably has one of those three. But the S&P 500 is pretty much the opposite of finding small, under-the-radar stocks. So the second passive investing play is my favorite way to invest in companies worth under $5 billion. These stocks are incredibly risky because they have a high chance of dropping to zero, but they also hold the potential for unbelievable gains. Sometimes 25 or even 100x returns happen in this area because it's like getting in on the ground floor of a new company. So my favorite way to buy these stocks without taking on too much risk is Vanguard's VBK ETF. It's a basket of small cap growth stocks in the market that I normally wouldn't want to invest in because they are so risky. But when you get a whole bunch of these and put them together, you can get a decent amount of the upside without taking the massive downside risk. Personally, I put 33% of my retirement into VOO, 33% into VBK, and then 33% into international stocks. And if building your portfolio is like building a kingdom, these three stocks, they act as the home base that passively grows through ETFs so that I can then use the extra money to go out from the castle and invest more aggressively within my circle circle of competence in technology. So in VBK, the small cap stock, I hold $16,000, and that's up about $1,000 overall. And then in VOO, I currently have $72,000, which is up $3,000 overall. And this website I'm using is called GetQuinn, by the way. It's a way that you can kind of import all your transactions into one place. And I think if you use the link in the description, you can actually follow my portfolio on there. But let's now move on to my single biggest investment I've ever made in one stock, and then I will show my entire stock portfolio and how everything fits together. But first, a favor if this video has been helpful. I'm right now on a mission to try to pass the Motley Fool in YouTube subscribers. We're still a pretty long ways off, but when we do, I'll be doing the FinTech Q&A marathon, a whole month where anyone can DM me on Instagram @RealFinTech, and I will answer any question that someone has for the entire month, however long that takes. And I may regret this, so subscribe if you want to help us beat the Motley Fool, or don't if you want to protect my sanity. But okay, let's move on to my biggest stock overall, and then we'll get to my full portfolio. So Crowdstrike is a leader in cloud-based cybersecurity, and they have been focused on integrating AI into their platform since the beginning. It's not just a buzzword for them. Their whole thing is looking at all the threats that exist in the world and training an AI to proactively recognize those threats rather than having to react after something has already happened. Crowdstrike has the best products on the market, at least according to Gartner. They rank above Microsoft and SentinelOne as a leader in endpoint protection. And this is the 5th time in a row that they've won that. The company is currently listed on the higher side of neutral, but still not overbought. And as you can see, the company's revenue has just been growing at an unbelievable pace over the past decade. The biggest knock against this stock is they are not yet consistently profitable. You can see they lost $20 million last year, but that's because the company is investing heavily in growth. You can see in their R&D costs that they spent over $1 billion in R&D in the most recent year. So theoretically, that all would have been profit, meaning they would have made over $1 billion. Now, that wouldn't be a good idea. They should be investing in research and development, but I think it's useful to sometimes look at these metrics below the surface to see, is this company non-profitable because it's a bad business, or because they're actually investing for the future? And in this case, I am confident Crowdstrike will continue to be the leader in cloud-native AI security. And the company's other metrics also look pretty good. But as promised, here is my entire stock portfolio as of today, which I'll also share over on my Instagram @RealFinTech, where I post daily stock updates and breakdowns. And if you want to subscribe to help us on our goal to catch Motley Fool, feel free to do that below. But now that you're on a roll, YouTube recommends that you check out this video next.